What is up, everybody? Welcome back to another episode of Fed Watch, the best macro show in Bitcoin. From a contrarian perspective, we cover macro, Bitcoin, U.S. economic data, global economic data, central bank news, all of that you get here on Fed Watch. I am joined, as always, by my co-host, CK. How are you doing, CK?
Doing good. Great intro. And yeah, I mean, personally, I think the most directionally correct show in Bitcoin. But obviously, we're a little biased here. We like what we do. And I think that we do put out some great information. And we got a lot to talk about today, diving a lot into the data. And I know that we're going to cover the US, we're going to cover Europe. We are going to be covering a lot. So, Ansel, as usual, is keeping the audience up to date with everything that is happening in Bitcoin macro, everything that is pertinent. And honestly, Ansel, you've been doing amazing daily content every single weekday on your Telegram and on podcasts. I have been absolutely loving it. I've been a big Ansel Lindner fan for a long time. And you're dropping a lot of contrarian opinions. If you want to stay ahead, if you want to of the noise of the herd, Bitcoiners are sharp, but you can stay ahead of Bitcoiners too. I think Ansel is one of the best people to be listening to. FedWatch, obviously, one of the best shows to be listening to every single Thursday. We stream live on Bitcoin Magazine. Y'all, I'm chilling right now. I'm chilling the show. I got to show the real show, which is the Bitcoin conference, Bitcoin 2023, May 18th through the 20th. We are working incredibly hard, and this is already the biggest conference that is going to be happening in 23. It is going to be the Bitcoin reality, the Bitcoin universe coming together in person live in Miami. You can't beat it. Bitcoin Twitter in real life, Noster in real life. You can meet me. You can meet Ansel. You can meet all of your favorites. Go to b.tc/conference. Check out our speaker list. Check out the sponsor list. Best place to get a job. If you want to get a job in the industry, best place to get a job at Bitcoin 2023. You can quote me on that one. Tons of companies have hired as well formed, funded at the Bitcoin conference, Bitcoin 2019, 2021, 2022. It is an establishment in the Bitcoin space. You got to be there. Don't miss it. Bitcoin 2023. All right, Ansel.
Yes.
What's the promo code? Promo code is BM Live. So use code BM Live to save 10%. Ticket prices are going up, so don't miss out. Ansel, what's up, man? Let's get into it.
Yeah, we put the macro in macroeconomics. We don't really get down into the micro weeds like a lot of people do. We look at things from a big picture and look at big picture items, which is what we're going to do today. Yeah, ISM data from the US, jobs data, US trade deficit data. So we're going to take a look at that stuff that's coming up. I want to tell everyone watching on YouTube or Rumble, like, subscribe. Make sure you're liked and subscribed to this stream right here. And we come every Thursday at 12:30 p.m. Eastern live. So from my side, you mentioned my stream. Yeah, you guys, I got a new YouTube channel. Got a new YouTube channel, so you guys can subscribe to my personal channel over at BTC Market Update. BTC Market Update is the new YouTube channel. Join the Telegram t.me/Bitcoin and markets. That is where I do live streams, usually every weekday. So it's going well, and hope to grow the reach of these contrarian takes. So that's all my plugs up front. CK, do you want to jump into? Let's jump into the Bitcoin chart first. How about that?
Love it.
All right.
And I've been bearish. I've been saying there's more ecosystem damage. There's more business and risk kind of like unfolding there. And you've been more bullish, which is a complete opposite to how we were both feeling when it was a bull run.
A year ago.
Yeah, a year ago. And I think you were right to be a little bit bearish, especially as we were off the all-time high. I kept thinking that maybe there is, an extended rally. The bull market will extend, but after the beginning of the spring, it really fell apart this year and got really, really negative. So you were definitely right there. But again, I would love to look at the chart, see what you think, and then give you my take because one of the benefits of being at Bitcoin Magazine is the information flow that you kind of get from the rest of the industry. So happy to drop as much of that as possible here for the listeners.
Absolutely. All right, let's bring up the first chart. This is the Bitcoin chart. I have on here some. Well, I changed my rocket from red to black because I thought maybe we shouldn't have a red rocket on the the chart. But anyways,
Red rocket, red rocket.
so as you can see, I also added the moving averages. Orange line is 200-day. Green line is 50-day. It was the first time we closed over the 50-day moving average yesterday, but we are kind of on a red candle today. So we'll see how we end up at the end of this week, maybe compared to the 50-day. But the 50-day is seen as the 50-yard line, like in football, right? If you're in bullish territory or bearish territory. So this kind of a big thing. I also highlighted a couple different sections of this chart, and you can see that compared to that 50-day, it looks kind of similar to what we were experiencing back in October. We did have that breakout, but then the FTX crash right after that. So, you know, let's see if we do something similar to what happened back in October minus the FTX crash. So this is, do you have any thoughts on this chart? I have one more with volatility for Bitcoin.
The 200-day average for me is the way that I define a good price. So as y'all can see, we are firmly in stacking territory, and there's definitely some resistance there with the 200-day moving average. Really interesting to see us so tightly coupled with the 50-day moving average, and hopefully breaking up above it is a good sign. But again, I think that narrative and the actual ecosystem reality, the jobs and the businesses and the players in the industry, we are still kind of in a death spiral, with many of them kind of like holding out and kicking the can on potentially eventual insolvency and issues there. So we're seeing a lot of noise with Silvergate just today firing 40%. That became public this morning. And then, obviously, DCG is under an incredible amount of heat, and we're seeing the legal proceedings with both Celsius and Sam Bankman-Fried continuing to progress. Bad news for people who left their funds in Celsius. You don't own those funds anymore. You are actually granting them to Celsius, and the Celsius Trust now owns those. That was a new decision happening, and all of that, in my opinion, is very negative for the price and very negative for the narrative. And I think that people are going to take advantage of that opportunity to beat up on Bitcoin while it's down. It's a buying opportunity. This is ultimately bullish as more and more coins get distributed at lower prices to strong hands and convicted hands. But that's personally why I think like this resistance is going to continue to pile on.
Yeah, and producer Chris just said Genesis fired 30% of their staff. So that's lots of firings going on. I know the miners are having a hard time hiring and keeping their staff. So this could be just maybe the next shoe to drop is letting people go. Maybe the industry needs to downsize here on the staff a little bit before
It is.
before
It
we
has
can
been.
go up. So I have one more chart here, and that is the volatility. The volatility in Bitcoin has been extremely low. The last two times it's been this low was post COVID crash and post halving. Got pretty much tied at this volatility level, and then you can see what happened there at the end of 2020 into 2021. But we also, if we go back to the next one, back in 2018, at the end of 2018. Oh, no, Chris, go. Yeah. At the end of 2018, that was right before the big crash. So hopefully we have a repeat of 2020 and not a repeat of 2018. But all in all, this is an extremely low period in volatility. So, and like I've said in the past, if you take out 22 days in 2022, the price, all those, the big crash days, the price has been pretty much flat all year long. So imagine what the volatility would be if we did that.
That was a take from your daily show, right? Where you're saying if you just subtract those kind of big industry events that turned into severe market selling pressure,
Yeah.
we could potentially be at all-time highs right now. So, That could be true. I don't know necessarily if we would be
Oh yeah.
sideways and up if we were at 50K or 40K at higher prices, but who knows? It's impossible to really speculate that accurately. But at the same time, you could argue that a big reason why we were at whatever price we were at was because of the leverage and because a lot of the
Hmm.
speculative and uh, honestly just unjustified degenerate behavior that a lot of these companies were involved in. But ultimately, all of this, it doesn't matter. It's going to be a blip on the radar. But, in the short to medium term, it does affect the price for sure, especially the marginal price for those that are, buying and selling on the market.
Yeah, that's a great point. Of course, I'm not saying that we can just do a one-to-one comparison if those days weren't there, because there's so much to take into account. When you're talking there, I was thinking of the altcoin side of the house, like these derivatives, like credit default swaps. Bets on top of bets on top of bets. It, it's famous from the great financial crisis in the traditional space. And Bitcoin is more like the actual economy and real world economic activity, where the altcoins are kind of like the credit default swaps on top. And what we had here was a kind of like a great financial crisis in Bitcoin, where a lot of the altcoins and a lot of the crazy leverage and what do you call it, yield farming and all that kind of stuff blew up on top, but it took Bitcoin down with it. So yeah, that's the main point that I have there. And with this volatility, we'll see. Something's got to happen, because historically Bitcoin does not stay at this volatility level for very long. Something happens here in very short time. So that's
So
all I
up
have
or
for
down?
Bitcoin.
You think up?
Oh, I think up. Yeah, I'm a perma bull. I think up, and there's just not a lot of Bitcoin to sell out there in my mind. So I don't think there's very far to fall if we do fall.
Yeah, I mean, if some of these companies do finally, are forced into bankruptcy or forced sellers, I definitely think that there's some coins that previously were not being sold that might, come onto the market because they're being forced to. So, again, we'll see what happens. I definitely think that there's a lot more headwinds still, but there's an enormous amount to be bullish about. The funny thing is that what I'm talking about is not Bitcoin network fundamentals. So
Right.
that's the beautiful thing is the Bitcoin network fundamentals have been doing nothing but going up and just improving time, day over day. So I'm not bearish in any way there, but I do think that a lot of the noise around Bitcoin is producing headwinds, and just a lot of the reality on the streets again in fiat world is pulling it down. So you talk about altcoins pulling it down,
That's
fiat is
true.
pulling it down. Like we live in fiat clown world, and that is ultimately what is kind of the driving force in human world right now.
Yeah, that's a great point. There's lots of stuff like stocks are also down, and they just can't quite find the market activity to push them forward. But I'm also a bull on stocks this year. I'm a bull in different aspects, not just Bitcoin. So that's the contrarian in me, and we'll see. We'll see what 2023 has to offer.
Very early.
Yeah.
It's a good thing the predictions are here live, so y'all can hold us account, and we try to hold ourselves to account as well. Yeah, I mean, I think that we have a pretty damn good record here on the show, and Ansel has been really on top of a lot of major trends that a lot of Bitcoiners are 180 degrees wrong on. As things begin to shift.
Absolutely. All right, so let's go into the next topic here. Should we hit the ISM data?
Yep, let's do it.
So, all right,
So, what is ISM?
ISM is the U.S. version. It's like a private company, and it's the U.S. version of PMI, the Purchasers Manager Index, where they go out there and survey purchasing managers and see if they are seeing an increase in business or a decrease in business. And if it's at 50, that means there's no change month to month. If it's above 50, it's expanding. If it's below 50, it's contracting. So let me, Chris, if you could pull up the next slide, slide number 3. And this is a story from Bloomberg. Manufacturing contracts for a second month. Prices ease. U.S. manufacturing activity contracted for a second month in December, capping the steepest annual slide in the key factory gauge since 2008 and helping to further tame price pressures. The Institute for Supply Management's gauge of factory activity fell to 48.4 last month, the lowest since May of 2020 and down from 49 in November, according to data released Wednesday. Readings below 50 indicate contraction. The figure was in line with the median estimate in the Bloomberg survey. Okay. The ISM index dropped 10.4 points in 2022. And if you go to the next slide, Chris, the biggest annual retreat since the Great Recession. The Purchasing Managers Group's measure of prices paid for materials fell for a ninth straight month, the longest stretch of declines since 74 to 75. So you can see what they're talking about here is 48.4 is the most recent reading, but it has been coming down all of 2022 pretty much, and it is the longest stretch of falling prices in this, or falling contracting ISM PMI data since 1974 to 75. So that is what I have. Oh, I have one more sentence here. Last month, the new orders and production gauges shrank, with each sliding to the weakest level since May of 2020 and signaling a further softening in demand. Measures of exports and imports also contracted. And we'll be talking about exports and imports here in a second. But what I want to get through on this is definitely that the U.S. economy is slowing. Okay, the U.S. economy is slowing, but these type of measurements are very hard to do when you have 9% CPI. Okay, so as CPI is growing, you have to think, okay, well, are the purchasing managers, are they thinking in nominal terms? Are they thinking in real terms? Are they thinking in volume terms? Like, how are they thinking about this? And so there can be some noise in this data, but we can see from this chart that it has been sliding and slowing for all of 2022. And yeah, so that's all I have on this. CK, do you have any commentary on the Purchasing Managers Index?
I mean, it seems as though things are definitely slowing down. It seems as though like the economy is less resilient and more fragile than it was prior, and there's just less growth. I think these are signals that things are increasingly more and more broken, and that these central bankers, with their what's the word I'm looking for? Um, uh,
Monetary policy?
Yeah, with their policy, but with their interventions, that's the word I'm looking for.
Yeah,
They're
yeah.
making things worse, which is, I think the Bitcoin thesis is that Bitcoin is a better monetary policy that can let humanity continue to operate without the drag of, kind of centralized interventions. Just to kind of add that things are slowing down, a recent interview from the CEO of Flexport, which is a big like shipping logistics company. He's talking about that we're definitely in a deep recession in the shipping industry, which
Yeah.
is something that we've been covering here on the podcast for a long time. Is this slowdown is something that Ansel's been signaling as bad news for China, and really interesting developments in terms of demand in general, as well as kind of what's happening with globalization and the pace of globalization and impact of it, previous or before 2020. So, again, I'm personally, I'm not a expert when it comes to ISM or other kind of producer pricing indicators, but that's kind of my 2 cents there.
Yeah. Great point on China, because, the U.S., the percentage of GDP that comes from trade outside of North America is only 10%, where in China it's 30%. So they are much more exposed to this type of slowdown. So if we see the U.S., and the U.S. is their biggest customer, basically. So if the U.S. is slowing down, that is going to have much worse knock-on effects down the road, especially when we see what's going on in China, and we have covered that extensively here on the show. So great
And can I
points.
just say,
Yeah.
we've been early to be bearish on China. we've been bearish on China when the large majority of people, including Warren Buffett, Ray Dalio, etc., Max Kaiser, love Max, but they were all bullish China. They were all talking about this Thucydides trap and the rising power. And we were all, and us on the show are bearish. And now we're starting to hear a lot of really smart people talking about how bad China looks and how in pain they're going to be from a shipping perspective, from the lockdown, from a real estate perspective, from zero COVID and totalitarianism, and how all of that is really negative for China. I'm kind of curious what your thoughts are on China in general, Ansel. I know it wasn't
Yeah.
on our agenda, but people are starting to turn bearish on China. I'm curious what you think.
Yeah, it's starting to shift a little bit, but there's still, I would say the consensus view is still being bullish on China. Just think about Zoltan Posnar. He is interest rate analyst with Credit Suisse, and he puts out these monthly dispatches, and I go through them every once in a while on my own show. And he is all about the China-Russia alliance and how the China-Russia alliance, along with emerging markets, are going to dominate the world, and they're going to de-dollarize, and they're going to, just take over, become the new hegemon. And so, yeah, and he's a very popular analyst out there. He's cited widely.
Super popular. He's going to
Yeah.
be at Bitcoin 2023 as well. So
Oh,
I
is
know
he?
that a lot of hedge fund managers follow him. So if you are
Yeah.
in that space, Zoltan will be at Bitcoin 2023. We maybe we can set something up where Ansel, you can challenge some of
Oh
his ideas in
man,
person.
is he speaking?
Oh yeah, he's speaking.
Oh wow. Yeah, that would be very interesting to hear him and what he has to say. Yeah, I disagree with him on almost everything. There's a few things that when I read through his dispatches, I agree with him on, but his China stuff, he's a big China bull, big Russia bull, big emerging market bull, and that is I'm polar opposite of that. But okay, let's go on to jobs data. Let's do that one. So this would be the next slide, I
U.S.
believe.
jobs data.
Yes, this is U.S. jobs data. And you can see this from CNBC. The headline: private payroll growth surged by 235,000 in December, well above estimate, ADP reports. So I'm going to read through a little bit of this here. Um, the jobs market closed out 2022 on a high note, with companies adding far more positions than expected in December. Payroll processing firm ADP reported today. Private payrolls rose 235,000 for the month, well ahead of the 153,000 Dow Jones estimate and the 127,000 initially reported for November. While the goods producing sector increased by a relatively meager 22,000, service providers added 213,000 jobs, led by leisure and hospitality, which added 123,000 positions. Professional and business services grew by 52,000, while education and health services added 42,000. So, big big gain in number of jobs. Remember, this is number of jobs. This is not employees, because the household survey is what measures the number of employees, and that has been flat for the last 9 months, where the number of jobs continues to go up. And where are all of these jobs located? 200 of the 235,000 are in leisure and hospitality, which sounds to me a lot like second jobs. People could be getting these second jobs as waiters or waitresses or something to pick up a little bit of extra money with the bad economy. So,
Driving Uber,
driving Uber, yeah, all that stuff. So they also talked about the
Instacart
stock.
delivery, like I
Yeah,
mean,
and
these
it's
are easy second jobs. You don't even have to necessarily get hired. You just sign up.
right. The stock market futures edged lower following the report, as investors fear that strong jobs numbers could push the Federal Reserve to keep raising interest rates. That was an interesting conclusion they have. And of course, I did want to bring up the FedWatch tool, but I forgot to add that image to the slide deck. The FedWatch tool right now for February 1st is the next announcement for the Federal Reserve and their policy. Uh, it's a over 50% think it's only going to be 25 basis points, but 43% think it's going to be 50 basis points. And something like this jobs number, this puts fuel under Chairman Powell's ass to raise rates some more. But yeah, that's all I have for the jobs number. Any other thoughts, CK?
I mean, the wild thing about the jobs number is, again, you're talking about the disparity between the household survey and the payroll growth, and
Yeah.
how that's indicating that people are taking second and third jobs. I would push our listeners to go check out on Reddit and type in, doing multiple jobs, Reddit on Google, things like that. There are whole communities around how to do this, with remote white collar jobs as well. So we're seeing the most productive people, take on multiple jobs. Maybe they're playing their employers, but on the flip side, these are very, very productive people. These are people who are making money and working at all hours. And then on the flip side, there are people who are completely unproductive, who are completely
Mm.
marginalized by the financial system, and that's a waste and a shame. And it's going to continue to be a drag on every country that's kind of suffering from this demographic shift, and from an economy that just does not serve the common person.
Yeah. I didn't know. I didn't know you could. They had Reddit boards just for second jobs. But
Oh
yeah,
yeah, it's a huge thing.
that's a sign of a coming recession for sure. I still think that, I mean, the whole structure of our economy is probably going to change because we're going to see a lot of deglobalization. We're going to see a lot of different sectors and different types of jobs. So we've been really going more and more towards service sector jobs. But if manufacturing comes back in a big way, there can be, people moving over to new jobs. So the next few years is going to be a big learning curve for a lot of people. Yeah. So that's all I have on the jobs report. Should we talk about trade deficit?
Yeah, let's talk about trade deficit, and if we have time before we switch over to Europe, let's try to jump into any of your thoughts around Fed minutes as well.
Oh, yeah. Okay. Okay. So the next one is the trade deficit. And the headline is, let's see, do I have a slide for this? Yes, I do. So slide number 6, please, Chris. So the headline is U.S. trade deficit unexpectedly plunges in biggest drop since global financial crisis. In a day when strong jobs data has been viewed by markets as bad for risk assets, as it signals continued economic strength and continued rate hikes by the Fed. We got yet another conflicting economic signal, this time from the latest U.S. trade deficit, which narrowed in November by much more than expected, according to the BEA. The November trade deficit narrowed to 61 billion from 77 billion in the prior month, coming in below the median estimate of 63 billion. Okay, so you can see that chart right there. I have a blown up image on the next slide to take a look at that chart. But you can see as that chart is going down, that means the trade deficit is growing. So imports are outpacing exports. But as that is coming back up now, in one of the fastest changes in the history of this number, we can see that the exports are rising relative to imports. All right, let me continue on this article here. Remarkably, the 20% 1-month decline in the deficit was the single biggest drop in the U.S. trade deficit on a percentage basis going back to the global financial crisis. And while it would have been welcome economic news if the drop in the deficit was the result of a surge in exports, the plunge was driven not by rising exports, but rather by shrinking imports, a telltale sign of an economic slowdown, with consumer goods, industrial supplies, capital goods, and autos all contributing to the decline, the U.S. Bureau of Economic Analysis said. To wit, while exports fell 2% in November, imports fell a striking 6%. So, and then they have some more details in this article. But CK, what do you think about this trade deficit? Oh, and before I throw it back to you, CK, one more thing is, this is for GDP, for real GDP and all of that, this is going to be a positive because imports are a net negative to GDP. And so when we have a trade deficit decreasing, that's going to be a boost to real GDP. And now, CK, back to you. What do you have to say on this one?
I mean, I don't have a whole lot to say other than the fact that all of these indicators are contradicting is just kind of showing how broken the narrative is and how much people are just kind of questioning what they're being told and the authority of the central banker and their position. They're saying all of these indicators are all telling different stories that are not 100% aligned with the story that the Fed is trying to say. And I think that that is negative for the myth of the Fed, which is something that we need to break down for Bitcoin to become global money, because people need to stop believing that they have the power to make changes. And, to be honest, here I am doing this show, and at times I have a heuristic that they have power to make changes. So, it's something that's very much kind of ingrained in psyche and a lot of people's mental models, and it's going to continue to empower the Fed. Just to kind of add on to the Great Recession in the world of ocean shipping. That's the specific quote from Ryan Peterson, who is Flexport's CEO. Things are looking painful in terms of imports. Again, that's going to affect China. It's really interesting to see the U.S. getting more involved in importing energy or exporting energy. I apologize. And I'm curious to see how that is going to impact this number moving forward. Is there a world where the U.S. becomes a net exporter? If we ramp up local production, if we continue to export energy and imports, continue to slide. I don't know if that's something that's realistic here, Ansel.
A net exporter of energy? Yeah. Oh, yeah, definitely. Especially natural gas. Right now, U.S. oil production is about 12.3 million barrels per day, and that is rising about 1% a week over the last uh, couple months. So we can see a continuation of that. And that is despite all of the harsh regulations that this current administration has put on pipelines, has put on new leases for exploration and drilling. So despite that, we're still rising 1% a week on U.S. oil production. So just imagine if things change in the future, if we get a different administration in 2 years or 6 years, and they open up the U.S. for more drilling and the pipelines and all that stuff. Just imagine, yeah. So the U.S. can easily become a net energy exporter. They probably will, even with all of these regulations put on them. So, yeah, that's some great points. I wanted to bring up the thing about the conflicting signals that you said, because yeah, we're looking at a few different things here. Some of them are like, should tell the Fed, dude, it's really, really bad. Don't keep hiking rates. The economy is really bad. But then we have that one standoff, which is the employment data that we talked about. How do you square these things? I think the Fed is irrationally focused on employment. Irrationally focused. For years, they had R star. That was like the uh, what's the term? Like the ideal employment rate, the natural unemployment rate. And they wanted to get towards R star, but they never could. All of their calculations, because they are uh, ruled by formulas. They aren't ruled by actual real life prices and real life data. They're ruled by formulas. And R star was this variable in their formula that they never could hit the target on for years and years. But now they've kind of abandoned R star, but still the prime metric for the Fed to stop hiking is employment. So we'll see what happens the rest of this year. Of course, my big thing is that the Fed doesn't control interest rates, which I don't have a chart this week, but you know, the long-term bonds are falling. They can't control that. The 4-week went down. I think it's still below the Fed funds range, and that's the 4-week Treasury bill. So they really can't control interest rates. So Yeah, that would be my response to what you said there, CK. Any back and forth for me?
No, I mean I agree that they can't control it, and I think that the biggest strength they have is the fact that everyone imagines in their mental model that they do, right? And
Mm,
that's how they're moving
yeah,
forward with making economic calculations. So it's like one of those things is once we stop giving them power, they stop having power, and that's why I think um, more and more people waking up to the myth and the fact that the Fed doesn't have power or control is the only way that we get beyond it. We just need to break that kind of critical mass of people who are under the illusion, if you will. Um, Ansel, do you want to jump
yep.
into a little bit of FOMC kind of highlights? I know that there's a little unplanned, but I know you did, as usual, read over all of that stuff as you watch the Fed.
Yeah, I wanted to talk about it today, but I decided to take that bullet point out of our outline because it was just really dense. My overall summary is that they don't think that they will be cutting rates anytime soon. And a lot of them think that they're going to be continuing to raise rates another roughly 75 to 100 basis points, up to into the 5% range for the Fed funds. But if you would have asked them back in 2020, or I guess even 2021, where they would, at the end of 2021, where they would be at the end of 2022, none of them would have said 4.25%. So they don't know. They can't see the future, but the sound of it is uber hawkish. So that's how I would summarize the FOMC minutes.
I mean, FOMC and the Fed in 2021. Thanks, producer Chris, for highlighting. They said we're not even thinking about raising rates. We're not
Yeah,
even
yeah, yeah.
thinking about raising rates. And see the 180 that we have now experienced. And again, uh, honestly, I think that the Fed is, you know, they're playing against the average person. They're hurting the average American in order to get their number right. It feels a lot to me, and I don't mean to kind of get away from the Fed realm, but it feels a lot to me like the COVID response. And
Mm,
they're focused on one specific data point rather than looking holistically. And I think that this is one of the key things that are wrong with top-down decision making, is because that is the nature of top-down decision making. You hone in on a KPI and you optimize for that KPI. And I think that that's a great strategy for a business that's kind of operating in a silo and
right.
competing in a market, but that's not a great strategy for a massive nation state to be making these kind of macro decisions around whether it's economics or whether it's health. So I think
Super
it's
good
really
point.
important to kind of highlight that symmetry there.
Yeah, super good point. And when you aim at one data point, that data point can be interpreted so many different ways. Like to take the COVID example, COVID deaths. Well, do we mean with COVID or from COVID? Yeah, how many comorbidities? What were the age ranges? And all of these things. That one data point is worthless, and that's what the Fed does. You're exactly right, but the Fed does this mainly from a psychological standpoint. Like, just think about QE when they do $60 billion a month in QE. It's supposed to be quantitative, which means exact and precise and calculated, but it's a round number. And it's not like 62 billion a month one month and 55 billion the next month. No, it's 60, 60, 60, 60. And same with these rate hikes. It's not quantitative. They're just winging it. And yeah, I think they are actually, like you said, they are losing confidence a little bit from people because all of these conflicting indicators out there. What does people know by seeing all these conflicting indicators? But Powell is so confident. They know he's not confident. They know that he doesn't know what he's doing. So anyway, yeah, we'll see. It'll be exciting to see what goes on in 2023, when they pause, when they pivot, um, and all of that. So the next story I have up here is from the ECB. Just is this today? Yeah, a blog post today. Did you get a chance to read this one from Panetta?
Nope. Why don't you give us the quick summary here?
Okay, well, I was gonna. read through some of this. The title is Caveat Emptor does not apply to crypto. And so the first section, he's bad mouthing crypto, and he brings up Terra USD, a stable coin that was stable in name only. And then he talks about all these failures this year. So I'll just pick up from a couple paragraphs in. These failures occurred in rapid succession, reflecting crypto players' incredibly high leverage, their interconnectedness across the crypto ecosystem, and their inadequate governance structures. Yet, remarkably, the crypto market route has left the financial system largely unscathed. Many, therefore, think it preferable to let crypto burn rather than regulate at the risk of legitimizing cryptos. Let me voice two important reservations about this view. First, despite their fundamental flaws, it is not certain that crypto assets will ultimately self-combust. Now that is a big statement right there. He said Bitcoin, I'm not going to use crypto assets, but he said Bitcoin will not ultimately self-combust. So that's a big statement from them. Continuing on, take unbacked crypto assets, for instance. They do not perform any socially or economically useful function. They are rarely used for payments and do not fund consumption or investment. Of course, that's wrong on many levels. The Bitcoin in 2022, Bitcoin processed over $1 trillion in dollar value, over the Bitcoin network. So, of course, it's used quite a bit. As a form of investment, unbacked cryptos lack any intrinsic value too, which of course is wrong. They are speculative assets. Investors buy them with the sole objective of selling them at a higher price. In fact, they are a gamble disguised as an investment asset. But it is precisely for this reason that we cannot expect them to disappear. And so even though he's saying this from a negative standpoint, these quotes are pretty damning. I mean, they say we cannot expect them to disappear. They will not self-combust. All of these things. So Bitcoin, even the ECB, I think the biggest enemy to Bitcoin, Bitcoin adoption or Bitcoin as legal tender or Bitcoin as a monetary standard, the biggest enemy is the ECB. And they've said twice now in this blog post that we can't expect it to disappear. We can't expect it to go away, which I think is a pretty big deal. People have always gambled in many different ways. And in the digital era, unbacked cryptos are likely to continue to be a vehicle for gambling. Second, the cost to society of an unregulated crypto industry is too high to ignore. For one, this year's crypto market meltdown caught millions of investors off guard. Uninformed investors were left with significant losses. It is not just cryptos that are being burnt. And I'll add here that, where were the regulators? It's not like this is totally unregulated. Bitcoin and the Bitcoin industry falls under banking regulations. It falls under securities regulations. It falls under all these things. So where were the regulators? Now the answer is not that we messed up. Sorry, as the regulator, we messed up and it's our fault and we'll fix it. No, that's your guys' fault. We had to put more regulations on you. So let's continue here. CK, stop me at any time you want to jump in. In addition, unregulated.
Well, I fully agree there. The laughable thing is that the SEC is too focused on the ETF, and they did nothing to protect investors from. And even like there's collaboration with one of the biggest frauds in history, and not. It didn't take that much investigation to find that out, right? So pretty much SEC did zero due diligence in terms of FTX, Celsius, etc. And on the flip side, the Fed, the ECB, other regulators who are regulating and heavily involved in this industry, there's no self-reflection, which is pretty common when it comes to regulators in general. And this is why you see the doubling, tripling, quadrupling down on bad policy before complete washing out and loss of faith.
Yeah, great points. I mean, we just heard too that when Sam Bankman was meeting with the president, they were talking about pandemic relief. Like, give me a break here. So yeah, the regulators from the top to the bottom, they all dropped the ball on these unregistered securities, this crazy leverage that was going on in the system. And they looked the other way. Seemingly, I mean, if you wanted to be cynical about this, you would say they looked the other way on purpose so that they can come in now and regulate even harder. But let me continue with a little bit of this. To avoid the risk of regulation lagging behind because of the time needed for legislative process, regulators and supervisors need to be empowered to keep pace with crypto developments. And to be effective and prevent regulatory arbitrage, regulation must have a global reach. The recommendations of the Financial Stability Board for regulation and oversight of crypto assets, activities, and markets should be finalized and applied urgently, as should the rules recently published by the Basel Committee for the treatment of banks' exposure to cryptos. So, first off, and I've said this before, they're pushing for global reach. They want this regulation to have global reach, to have coordination throughout the entire world on this, right? In an era of deglobalization, in an era where trust is breaking down. So that is not going to happen. If they want to do this, they're going to have to go out on a limb by themselves, the ECB, and totally ban stuff and do their regulations. They're not going to get buy-in from India. They're not going to get buy-in from Indonesia, from the United States, from Mexico. They're not going to do that. They're going to have to do it on their own. So that actually, to me, is like, that's kind of I guess, a good feeling that they want this to be global, but it's not going to be. They're not going to get that help. So I have one more sentence, CK, and then I'll hand it off to you. So, however, regulation and taxation alone will not be sufficient to address the shortcomings of cryptos. To build solid foundations for the digital finance ecosystem, we need risk-free and dependable digital settlement asset, which can only be provided by central bank money. So I highlighted that sentence because I thought you would find that interesting, CK, that what they want is a risk-free and dependable digital settlement asset. Well, what about Bitcoin? This is the most risk-free it can get. One Bitcoin equals one Bitcoin. It's dependable, digital settlement. But no, they have to add on a central bank money. So, okay, CK, throwing it back to you. What are your thoughts on this blog post?
Huge LOL. And I think you did a great job of pointing out, one, where they're right about Bitcoin, and then two, where their remedy is impossible. I guess the only thing I have to add is that
Yeah.
Bitcoin is better at global coordination than any central bank is, than any government is. That's the whole point. It is a massive innovation in collaboration and coordination that does not require trust, does not require building a relationship. So it has out innovated them, right? So they can't beat Bitcoin at its own game, which is the global game, which is the global coordination game. So Bitcoin will always be a step ahead. And it's laughable to see central bankers thinking that they have this ability. And it's even more laughable to them thinking that they are the only ones that can provide a dependable digital settlement asset, because we're in this mess because of them. So they can't do so. And it can only be done via Satoshi's innovation. So good luck to them. But I don't think it's going to work out for their favor or how they think.
Yeah, I mean, communists always think that they can centrally plan everything, that they are the source of stability. And I just think it's funny when they use risk-free. Well, Bitcoin is counterparty, there's no counterparty risk with Bitcoin, but it is all counterparty risk when you're talking about credit-based money, 100% counterparty risk. So I just wanted to point that out. All right, man.
No, totally.
The last story I have is the German CPI. I don't have any slides for this, but German CPI came out a couple days ago, and the headline was, it's 8.6% year on year, down from 11% or something. This is a big move down. But what I didn't find in any of the mainstream media articles that I looked at, none of them were talking about the month-on-month number. And guess what the month-on-month number was for December? Almost negative 1%. negative 0.8% for German CPI month on month. That is incredible. And if they've hit peak CPI and they start coming down, I mean, this type of narrative of the CPI, which we are going to get US CPI for December next week, we'll be talking about that. But if CPI continues to fall and rapidly, like imagine if the US had a negative 1% month. I mean, the year on year number would drop probably to 3-4% in just a few months. So I think that's going to be a developing story here in the next 6 months is the CPI is just falling off a cliff. So, and any thoughts on German CPI or to sum up, I guess, final thoughts here?
Well, no, hey, my only thought is that this has been Ansel's latest kind of tip is month over month being a much better indicator than annual CPI numbers. Annual is what everyone uses, unfortunately. Ansel has been talking about CPI going down. So I think we should just leave it there. Y'all pay attention to month over month CPI, and it'll be very interesting to see what the central bank narratives are going to be if CPI continues to fall, and they can no longer say that they're fighting CPI and fighting inflation. But that's all I got, y'all. It's been a great week. It's been a hectic week. I feel like winter is kind of thawing here in North America a little bit. I feel like everyone is kind of getting back from the holidays. So I'm excited for the energy of next week. There's going to be a lot of people here in Nashville for what's going down at Bitcoin Park. There's a nice mining summit. So if you're going to be in Nashville, hit me up. But if you want to come to the ultimate event for Bitcoiners to gather at, that has to be the Bitcoin conference, May 18th through the 20th. So I'll definitely see you there. And I think Ansel will be seeing you guys next week. I will be doing some travel, so likely Nolan will be joining for that show. Will be very interesting to talk about US CPI numbers with Ansel and Nolan.
I got one more housekeeping item here at the end. We did switch our podcast feed. So we were on a standalone podcast for this Fed Watch. We joined the Bitcoin Magazine podcast feed. So you can find that on Anchor. You can find it on Spotify, of course, all the podcast apps. So make sure that you are, if you want to get the podcast version of this, that you guys are signed up to the Bitcoin Magazine feed. And also, I want to invite people out to Bitcoin Day in Naples coming up this month. I think it's the 21st. Now it might be the 22nd, but it's 21st or 22nd. They're in Naples, Florida. I'll be speaking with Greg Foss. It's a great one-day event, a very cozy event where there's only 100, 200 people that come and show up, but you get to talk directly with those people instead of seeing them on a big stage. They're right down there with you. So check out bitcoinday.io, and I'll see you there.
All right. Peace.
Peace, guys.
Code BM Live.